For more analysis on the moves in the energy markets, I'm joined on the phone by Schork Group President Stephen Schork. He joins us from Jackson Hole, Wyoming. Stephen, good to talk to you again. You just heard Alex's report. What's your reaction to what's going on in Libya?
I tell you what, Mark, I am dumbfounded that the oil market has not responded to this news. Think about it. We've had an OPEC member essentially commit an act of war against the United States, and the market is just shrugging it off. As Alex pointed out just now, the loss of Libyan barrels last year because of the civil war was the main reason that pushed New York oil to $115 a barrel and pushed Brent crude oil prices close to $130 a barrel.
Right.
So this kind of strife, and if we see any sort of disruption to the flow, will certainly ignite this market higher. It's quite perplexing right now that the market has chosen to shrug it off. Quite telling,
Yep.
I think.
Stephen, are you surprised at the support that oil received today following that German court ruling clearing the way for Europe's permanent bailout fund to be ratified?
Yes, indeed. I mean, of course, now with what's going on in Germany is not necessarily an economic demand driver, but this is more of a currency story, and what this has to hold in store for the currency, a potentially stronger euro, weaker U.S. dollar, and certainly, as we've known from the past, a weak dollar is absolutely supportive of strong oil prices.
Stephen, what implications could a Fed decision to implement another round of asset purchases have on oil? During QE1 and QE2, investors piled into riskier assets like oil. Could we see a repeat?
Oh, absolutely. If we start to see a knock-on weakness to to the dollar, that is absolutely going to translate into higher oil prices. I'm here in Jackson Hole speaking with industrial clients in the West, and they're quite dumbfounded, so to speak, with regard of the price increases that we've seen in the food section, let alone in the oil section. And yet we have a Federal Reserve that is absolutely turning a blind eye to the inflation that consumers are seeing both at the grocery counter and at the gasoline pump.
Stephen, we have a little less than a minute. We're seeing the gap between Brent crude and West Texas Intermediate starting to narrow. Why, and how closely is the market following this?
Market's following it very closely, Mark. We've had new production or production coming out of maintenance in the North Sea. So we have 200,000 barrels a day of new oil shipments coming out of the North Sea. We're also going into the turnaround season. So there's less demand by refineries for crude oil. So you have about 1 million barrels a day in Europe of refinery capacity that's being shut in. You add in the 200,000 barrels of new production coming back online. That's a 1.2 million barrel per day swing in oil. So there's more supply getting in the market that's weighing on the Brent market, and which is supportive of that spread.
Stephen Schork, president of Schork Group, joining us from Jackson Hole, Wyoming. Stephen, thanks so much.